everybody. Welcome to your Thursday edition of the TraderMerlin show. I was talking to you guys yesterday about guests. I said, I don't know if I have a guest. I had some options questions, and I thought, you know what, why don't I just bring on one of the options experts out there? So I'm going to make it real quick and easy with our introduction today. We're going to talk about getting to know the Greeks. No, we won't be doing Zorba the Greek smashing plates on the table or floor, but we will be having fun talking about 5 of the letters out there. Of course, if those who know, 4 letters are actually Greek, 1 is not. But we're going to talk with Corey Lane about that today. So, Corey, how you doing?
What's up, my friend? How are you guys?
Good. Yeah, it's funny. I was just looking at the call log. It's been a month and a half since you've been on the program. I thought we had some love here, brother. What's going on?
It's ridiculous. It feels like it was just 2 weeks ago, and I'm so happy that you reached out today because, yeah, I can't get enough of you, buddy. So,
yeah, there we go. Perfect. Joseph says, did Corey do the intro music? Joseph, I can't afford Corey's fees for that he charges for his music for his shows and stuff. So,
Merlin, if you need music, you got music. Just let me know what you want.
I go to royalty-free sites. That's where I'm going. All right, Corey. So let's dive into it here. Of course, as we get through this, we can talk about current markets and trades and setups. But I wanted to go into a little bit about the Greeks because I've had a couple of questions pertaining to those. I won't mention the people's names because there was a few of them just about very basic Greeks. So obviously for somebody who's trading equities, you buy, you sell. It's simple. If you're trading futures, you buy, you sell, you short. It's simple. You're trading Forex, you buy, you sell, you short. It's simple. With options, you can still do those things, but there's some metrics out there that when you take a step back and look at them, they're designed to help you increase your probability of being on the right side of the trade, help you manage your risk, and those come in the form of Greeks. So where do you want to start with our introduction here to the Greeks?
Yeah, so I think that's a great way to kick it off. One thing you said is the Greeks exist as a way for us to help us, manage risk and reward and things like that. I mean, the Greeks, which are really, really fundamental parts of options trading. I've met people in the past who say, I'm not going to use the Greeks. I don't use that. I just buy and sell calls and puts. Mm-hmm. I don't even use the Greeks. Well, I've also met people who trade without looking at charts, and I don't know how they do that.
Tea leaves, man, tea leaves.
I have no idea how they do that, because when it comes to the option Greeks, one of the things, with all trading, Merlin, as you know, is we're always in a constant state of optimizing our approach, our strategy, right? We can always do better, but if you don't know where you're getting it wrong, then how do you know where to be better? You know what I mean? Mm-hmm. And so with the option Greeks, it's very easy if you don't pay attention to delta, theta, vega, not so much gamma and rho as much, but we'll talk about them for a minute. But if you don't pay attention to the Greeks, then you might end up being very right on your overall directional outlook and still lose money because you don't understand how sensitive your option is to other factors, right? So to me, these are extremely critical that we learn very early on when it comes to option trading, so you can maximize your potential outcome and minimize the overall risk.
Right. So let's real quickly, let me just throw something in here. When you trade in different asset classes that are non-options related, Corey just said something that I think a lot of people might perk their ears up to and go, well, hold on a second. You said you can be right directionally. And if you're a futures trader or Forex or equities and you're right directionally, you've made money. That's pretty much all you can be, is just going directional. You're going to either go against the trend or you're going to go with the trend and use direction. So for me, when you look at that statement, okay, it moved in my favor, I didn't make money. How is that possible? It's when you add in things like time decay, which of course we'll look at some of the Greeks here. You have specific rate of change pieces, which is how much that option follows the underlier, so it may not move 1 for 1. So there are factors out there. Even though you are right in picking direction, you could still theoretically lose money with options. So that's I just wanted to say that because I think some people think if you're right directionally, you automatically make money, and that's not true in the option space.
Yeah, that is absolutely true. And I have some kind of graphics and some slides we could go through if you want me to share those, Merlin, because there's some things in here visually that I think people could pick up on to start to understand why you might get yourself into a situation you didn't expect. So
any visuals you want to share, as long as it's PG-13, you feel free to share with our audience. You know what? We're not even regulated anymore. Go ahead and go beyond PG-13.
NC-17, here we come, people. Ready? All right. The Greeks. You should see that, right, guys?
Yep.
Awesome. So this is a presentation. It's actually part of an on-demand curriculum that we have at Traders Army regarding all option trading. And we start out lesson number 6 with the option Greeks. And so I'll pretty much kind of skate through kind of the explanation of what they are. I'm not sure if you've got a lot of option traders watching right now, or if you got a lot of folks who are somewhat new to option trading. But the option Greeks are very simply how we measure our risk and our reward potential based on variables that exist inside the marketplace. The variables are, what if the underlying stock goes up or down in price? What if the demand for those options goes up or down? That's going to influence the options. That's known as implied volatility. As time goes by, these options are contracts just like insurance contracts, and they have a time decay that every day the option is out there on the open market, whether you own it or not, the option is decreasing in value every day as it gets closer to expiration. And then interest rates are a part of the equation as well, which interest rates are not moving. Generally, they tend to not move very quickly, very often. So generally speaking, the option Greek related to interest rate changing is not one that we focus on a regular basis. We get ourselves into a rapidly changing interest rate environment, and all of a sudden that becomes really important, right?
Right, yeah. Right now, we're not there.
We haven't been there in a while, right? So it's been kind of one of those, it's called rho is what it is. That's the interest rate. That's the Greek that is associated with interest rates. But at the very, very least, Merlin, I want everybody to walk away with, you have to know what the hell is delta, why should I care? What is theta, why should I care? And what is vega, and why should I care? Those are the three big ones. Gamma is technically a secondary Greek. Right, so most option traders are just going to focus on three option Greeks and that's all we really need. But understand that these are complex vehicles in a sense that there are primary Greeks, delta, theta, vega, and rho, and then there are secondary Greeks. Gamma is a secondary Greek because it affects another Greek. So gamma is going to affect the delta. So that's why it's called a secondary Greek. And there are even tertiary Greeks, if you believe that. There's something like 24 Greeks or something crazy like that built into the Black-Scholes formula. And the good news is, Merlin, we don't need to know most of them.
That's good.
Good thing. I'm not going to make this a Black-Scholes conversation. But delta, theta, and vega, we have to know. So what are they? Delta tells us how much we can expect to see our option change in value on a $1 move in the underlying. So price of the stock goes up and down. That delta is going to affect our option premium. Right? That tells us how sensitive we are to the stock moving. If our option carries a delta of 0.50 per share, so delta is per share, then you're 50% sensitive to whatever the stock does. Make sense?
Yeah.
0.50 is 50% sensitive. And so it's really critical that you understand if you're expecting to make a directional profit, meaning buy an option. If you buy a call, you expect prices to go up. If you buy a put, you expect the stock to go down. So if you're buying a call or a put option, then this delta will tell you how much you expect to make or lose if you're right or wrong on direction. So that one is absolutely critical, right?
Yep.
However, here's how you could be right on direction and still lose money if you're not careful. I'm going to jump to theta really quick. So theta, T-H-E-T-A, is our Greek that measures the rate of time decay. So every day this option is getting closer to its expiration date, it's decaying like an ice cube melting. And so if you hold an option like you hold an ice cube in your hand, that ice cube is going to start melting immediately. Well, so is your option. Your option is going to start decaying immediately. It's pennies per day, generally speaking, 3 cents, 5 cents, could be 10 cents a day. But if you're holding a position for a week or 2 or 3, think about this. If you've got 5 cents a day you're losing on your option premium, and you hold this position for 10 days, there goes 50 cents in option premium right there.
Mm-hmm.
If the stock had moved in your favor, then you made money there. But if you lose 50 cents in time decay, then you're not making as much money as you would have hoped to have made, or maybe expected to make. You with me?
Yep, absolutely.
And that's just due to time decay. Now, where does all that money go, you say? Because if I put an ice cube in my hand, let's call my little iPhone brick the option, and it's my ice cube, and it's melting, melting, melting. So if the option that is being held, meaning owned, if you bought it, is melting, then where's all that money going? Well, the seller of the option has a cup which is empty, and it's holding his hand underneath the hand of the buyer who's melting. I don't know if you guys can see my hand here, but
no, we got your screen.
if I hold an ice cube in my hand and it's melting, then the water drops are going where? They're going into the cup. So the buyer of the option loses money. The seller of the option collects that money, and all the way out to expiration, whatever the buyer bought in terms of premium related to time is gone, and it's gone into the seller's cup. And that's the idea. That's what sellers expect to make money from, is time going by. They make the money that buyers lose.
Right.
You guys follow me?
Yep. And with that,
fun,
let me add real quickly here, just so I can throw in 2 cents. When you're looking at theta, you also have to understand that the longer time that you have, the less melt you're going to have, so to speak, in that example that Corey was just talking about. So, as someone who's buying an option, obviously the longer I have, the better. So that time decay is going to be kind of sloped. And actually, he's got this theta time decay curve up here, perfect, which is exactly what I was just going to go into, but didn't know you had all the graphics prepared for me. Thank you.
Dude, I got you, Merlin.
You notice that first couple of months, it doesn't deteriorate that quickly. And then all of a sudden near the end, this is where it really starts to fall apart. This is why if you're selling options, which I like to do, I'm not going out and selling a 5-month option. I'm going to sell an option that's like probably 30 days or less, usually is what I'm trying to do, because I want that time decay in my favor, and that's where I'm looking at theta.
That's right. Yeah. You always have to remember, what is your competition trying to get out of this position? And if the other person is buying that option, they expect a big move in a short period of time. Mm-hmm. So if you don't expect a big move in a short period of time, you'll sell that option to them all day long. Right? It's kind of like an insurance company selling a really low risk policy to somebody going, yeah, I don't expect that I'm going to have to pay out on this policy. I expect to just collect this premium with a high degree of probability. So we do that on a short-term basis over and over, and we could easily make a lot of money doing that. But we have to plan for, what if the market moves against us? We have to obviously plan to manage risk in that situation.
Right. And this goes back to, I have a bunch of different things that I do in the trading world, and one of those is every month I will sell. I'm going to sell puts on the indexes, either the NASDAQ, the Russell, or the S&P, and it's going to be for the next month. And it's because I'm trying to capture that short part of the curve as the theta is just falling off the cliff there. I'm hoping that that's working in my favor. And, you can find nice strike prices where you can get far enough away from current strike that you'll get yourself 1% a month without taking on too much risk. And that's been, kind of one of the strategies I'm using for one of the accounts. But just there's so many different ways to skin this cat.
There are many different ways, and there's no shortage of things to learn in options. There's no shortage of strategies that you could learn. I would say most of them you're probably not going to use, but a handful of 5 to 10 different option strategies for different periods of time related to time decay, for different periods of volatility. That actually is related back to vega, which is the implied volatility of the stock itself. That's one big one that I think most people, vega, which is implied volatility, that a lot of traders tend to not pay as close attention to volatility exposure as they would need, right? I don't know if you found that in your conversations with people as well, Merlin, but as an options instructor, this is where people can really get messed up if you don't pay attention to vega.
Yep,
because let me point something out about this, right? Implied volatility is related to the underlying stock, but specifically, how much is the stock expected to move in the future? Merlin, I'm going to share a chart with you.
Yep, I see it.
We'll just look at Dave & Buster's real quick, right? So, because this is the chart I have up. So down here on the lower part of this chart, I actually brought up our implied volatility indicator, which basically takes the whole last 1 year of volatility, and it looks at how high has volatility been in the past 1 year, how low has it been, and where are we currently relative to the extreme high and extreme low. And we've programmed this indicator to give us the upper 20% of the range and the lower 20% of the range to tell us where can we sell options when they're really, really high in price, and where should we be buying options when they're really, really low in price. Everything else is going to be some form of a spread trade, okay? Because we're not exactly really high in price or low in price, so we're going to offset our risk. And you might be saying, our risk? What do you mean our risk, right? Well, think about this. If volatility is expected to go up because prices are very low right now, then we would want to be a buyer of that product that is expected to go up in price. Similar to if a stock came down into demand, we would want to buy that stock. If an option price came down into demand, we would want to buy that option, right?
Yep.
If prices were way high, like they were back in March and February, then would we want to buy these very overpriced inflated options? No, we wouldn't. But are there people out there buying overpriced inflated options and not even aware that they're buying overpriced inflated options? What do you think?
I'm actually just reading all the marks you got on your screen here. I can see your short 1250 put, October 16th expiration. So again, you're sold with a month out, right?
Yeah, I sold with a month out. And of course, today they announced they might have to file for bankruptcy. That's of course, news, right?
Yeah.
But it actually came down and, whoops, I didn't mean to do that. It came down, found this recent demand, which I'm trading off of, and I just needed to stay above 12.5. Come on, people. It's not that difficult. But if I have to manage and roll this position, then I'll manage and roll this position. But essentially, this down here tells us where options prices are expected to go. And if you're not careful, you could be buying a way too expensive option. Now, let's consider this for a second. If you buy an overpriced option and you get the move that you were expecting, and the volatility gets dropped out of that option because the move that was implied, the move that was implied actually happened, but you paid for that move in advance, then you might make money on the move, but then lose more money in volatility. And this is where people can be right on direction and still lose money because they're not putting as many factors as possible on their side.
Right. And you see this a lot when you have real big spikes in volatility, like particularly, going into an earnings announcement. You generally before that announcement, volatility is off the charts. People buy it, think it's going to go one direction, and they may be right in that direction, but it didn't move enough to cover the volatility. Right.
Yeah, people out there buying Tesla options right now are buying very expensive options relative to where they were even just a month ago. So they're well overpaying for those options right now. And so basically what has to happen is the market, Tesla, right now with implied volatility priced at 125%, what this number means is Tesla has to move 125% up or down over the next 1 year to justify paying for today's options prices. So
it's possible.
What are the odds Tesla moves 125% over the next year to get you what you paid for to be worth it? Possible, but if you want to trade possibilities, go to Vegas.
Yeah. I was going to say, of all the stocks out there, Tesla is the one that just leaves people scratching his head. So certainly it is possible, but boy, that's a steep mountain to climb.
It's a steep one to climb. And one thing that you mentioned, Merlin, that I want people to watch out for is, okay, time decay. Let's go back to that for a second. A long-term option has very low sensitivity to time, meaning you're not really losing very much money every day if you open that position. But the thing about volatility is, if you're close to expiration, you have very little what's called time value or extrinsic value. Therefore, fluctuations in implied volatility are not going to affect your option by that much. But when we go out, Merlin, and we buy a longer term option, think about this from, I wish I had a prop here. I used a curtain rod in my last class. But basically, you have very little movement here, which if you move just a little bit here near term, that affects a longer term option a lot more. So while your long-term option may be less sensitive to time, it instantly becomes more sensitive to volatility. So we always have to pay attention to this balance between time, volatility, how close we are to expiration, and of course making sure that we look at the underlying stock if we have a directional bias. You follow me?
Yep.
So some pretty neat stuff in here. And one little thing that I like to do with students as well, which I think this is the best way to learn options, right? I mean, I saw somebody ask, at the very beginning, before you even started, Merlin, what was it? Texas Jack? Somebody asked somebody about, I want to learn how to trade. Where's a good place to start? Well, if you want to learn how to trade options and futures, come see me at Traders Army. But options specifically, what I run all my students through is I run them through tests, right? And this is one of those tests. because there's no better way to learn options the same way that you learn math, right? Is to learn how to do it with a pen and a paper, pencil and a paper, or a whiteboard so you can draw it all out and do the longhand. I know that we have calculators, people. I know, but if I just give you the calculator and say, just use this, you'll never really learn options. So what I do is I go through this whole lesson on Greeks, right, which are measured in cents, dollars and cents per share. So 0.52 delta, 0.06 gamma, 0.09 theta, 0.14 vega means that if you buy a call option, you expect the price to go up. If the stock goes up by $1, you make 52 cents. That's delta. If the stock goes down by $1, you lose 52 cents. And then gamma will actually change the delta to make it either a bigger delta, so now we're more sensitive because the stock is moving in your favor, or it'll subtract 6 cents from the delta if we're losing. So it actually will slow the rate at which you lose money and accelerate the rate at which you make money. And that is very unique to options, Merlin. You can have accelerated profits at the same time, if you're losing money, decelerating losses, which in both cases are amazing, right?
Yeah. I mean, anytime we can slow down the losses, I mean, I always make that that's the point, that trading is more about the losses than it is about the gains. You take care of the losses, and the gains will just take care of themselves, and it ends up being a good career.
1,000,000% agree. So theta on this one tells us we're going to lose 9 cents a day because we own the call, and we are sensitive to volatility. So if volatility changes by 1 percentage point, Tesla was at 125. So if Tesla goes from 125 to 126 or down to 124 by that's 1 point move, this option is going to make or lose 14 cents, and that's a per share basis. So if we know this information, which by the way, we get all the option Greeks from your trading platform. So if I pull up the option Greeks on Tesla, I pull up any old expiration month, and I pull up all of the Greeks here, delta, gamma, theta, vega, then you can see all the individual option Greeks here. If I scroll down.
Right, getting your near price. Yeah, current price, guys, right on Tesla is about 423.
Holy moly. Here we go. There we go. There's our option Greeks. So this is where you get this information from. So if we just take this information with the option premium attached to it, I run this with my students. I say, what if the stock goes up by $1, 4 days go by, and volatility goes up 2%, and the starting value of your option was 350? Run these numbers with these outcomes and tell me what that option should be worth. And we run this 3 or 4 or 5 times in a row so people can get a feel for exactly how option positions evolve, because that's critical. Understanding how your option position is going to evolve over time. So we do a lot of this by hand first, and then that way when you use option analyzers and tools, you know exactly what the calculator is doing. Right? Which is a really great learning tool.
Real quick, there's a question came in from Adam, and I see a bunch of great questions, guys. We'll get to all those after we kind of get through the overall Greek session here. Adam says, how do you know what a proper Vega level would be without looking at a volatility chart?
You don't.
There's the answer. That was easy.
You don't. And let me explain why. Because, and by the way, I just literally had this conversation with a student I was mentoring yesterday one-on-one, and said that they were screening for volatility, right? They said, show me high volatility stocks. And they were coming up with a whole bunch of different stocks in the $150, $200, 150%, 250%, 300% volatility. Yet when they pulled up the chart, that was still low. Here's why. Volatility is all relative, right? Like is Corey strong? Well, compared to my 13-year-old son, yes. Compared to Dwayne "The Rock" Johnson, no. So it's all relative, right?
Yeah.
So at least I think so.
You're right. I think you'd take The Rock. I'd like to see that fight. I think it'd go down.
I'd like to take The Rock. Why don't you pull that up on your show then, Merlin?
I'm going to get him on after he's done selling his tequila gratuitously online.
Why don't you get that Dwight Traderman on here? See if we can. Oh
yeah, that chump! Stronger. I tell you,
chump.
These Chicago quasi floor traders blow my mind.
Unbelievable, right?
Yeah.
So we have to look at it and say, where is volatility today compared to where it's been, right? Where is it today compared to where it's been? And so there's really no way to know, because Tesla's at 125. with a range of 186 and 36. I'm just looking at the numbers over here on the far right. If I pull up GE, there's a range of also 30 to 160, right? But 60 is low on the range here. If I pull up Ford, the range is 23 to 278, right? You pull up something like Apple, and it's 100 by 20. So the range is based upon that particular stock. So we can't really judge is volatility high or low until we actually look at the volatility chart on it, because we have to compare it to itself, not just in general. Make sense?
It makes sense. Bring up, I'm curious what Nikola looks like on yours, NKLA. Because that one was going nuts.
It is going nuts. And because it hasn't been on the market for, I mean, this thing IPO'd when?
It didn't IPO. It was a SPAC reverse merger thing. They backed into a shell corporation.
Oh, got it. Yeah, so we're not even really getting much in the way of implied volatility, because this requires, a certain amount of time, at least not for this indicator. So if I pull up implied volatility just as a standard indicator.
I was just thinking, because there's a couple that have happened recently that have been like just absolutely ridiculous. Like Kodak is probably another good example, right? Now that thing's just dead in the water now and probably going to head right back down to where it was. But there are these periods of time where you mentioned things being relative. Well, I mean, guys, Nikola back in May had an implied volatility of over 500%. That's insane.
That's insane. Yeah, you can see way up here was 493%. Yeah. Yep. And then somebody out there was buying options.
Sure.
And they were paying 490% premiums for them. I saw an option the other day, Merlin, that the stock was trading for $25 and the option at the money was trading for $9.
Wow, I'm a seller.
I'll sell that all day long. It's
all
50% of the price of the underlying, so you might as well just buy the underlying and forget all these option Greeks.
Yeah, crazy.
At that price. So.
All right, cool. So that was the proper use of Vega. Let me see real quick. Anthony says, hold on, Anthony. I'll get to that one. I think we want to go to Joseph's here. So what about open interest on the daily option volume? Does that factor into your gamma discussion?
Gamma, no. But it does factor into my my willingness to want to trade those options altogether, right? So if we go back to, I could just stay on Nikola here, right?
Yeah.
So if I pull up volume and open interest, volume is something that starts over every day. So it's always going to be zero at the beginning of the day, and then it'll accumulate over the course of the day. So volume is less of an indicator for me of anything, because I do a lot of my trading earlier in the morning, and I know volume is going to be low. Now, open interest is critical, because that tells us how many contracts are already open. So if you've got thousands and hundreds, if not thousands and thousands of contracts already open, you know that you're not the only person out there trading these. And therefore, the spread, this is after hours, so it's not ideal, but the spread between the bid price and the ask price, if you have a lot of interest, is generally going to be very narrow. And we look for narrow spreads. We look for the ability to get in and out quickly, and that's where open interest is a huge factor. So I need at least a couple hundred contracts, at least 100 contracts to really even think about trading something. Couple hundred is ideal, but if you've got thousands, like, for
SPY
instance,
or something.
Yeah, SPY, SLV. You've got tens of thousands of contracts. And look how wide the spread is. That's what we want, right? Without interest, you're trading against yourself or the market maker, right? And you're always going to get ripped off there. So that is critical.
Yep. Let's see. There was another question. You have two different measures that you were looking at. You were looking at historical versus actual volatility. That was from Juan Manuel Martinez. Says, I get confused with this. What's the difference between historical versus actual volatility, and which one should we be looking at?
So, great question. So, historical versus implied volatility. Historical volatility is a measurement of how the stock has been behaving. So if you've got a really volatile stock that's been very volatile, you're going to have really high historical volatility. It looks back over the last 30 days. And this is the actual component that actually gets plugged into the options pricing model to identify theoretical value. So for instance, you may have a theoretical value on this option for silver. Let's just say the theoretical value, because historical volatility is very low. Just looking at the last 30 days, this thing has gone nowhere. So historical volatility would be very low, but implied volatility may be higher. Why? Because if there's demand for the options on silver, then the options market will inflate the price of the options, which will then imply that many people believe silver is about to make a bigger move than it historically has been. That's where implied volatility comes from. It comes from the option premiums. And so historical volatility to me isn't that important at all, simply because I know that the stock could be volatile, could not be volatile. I know that that goes into the formula for judging theoretical value, but I never look at an option trade and say, theoretically, what is this option worth? Because, you know, I could look at any stock. You know, I could look at GE and say, well, if I run this through a fundamental screener, GE is worth $1, but it's trading for $7. So I'm not going to buy it until it trades for $1. Well, you'll never pay $1 for it, at least not anytime soon. But if we look back at GE and see that there's a lot of demand around 575, or the most recent demand that triggered this yesterday at 620, then you might say, well, if prices actually get down to 620, I'm a buyer. Well, historical volatility says, theoretically, this is where options should be priced. And a lot of times the options are never priced where they theoretically should be. They're priced where the market says they are because of all the real demand and real supply. So if I look at this and I say, implied volatility has dropped into an area that has been historically proven to be low, and we expect to see a price rising, I'm going to buy options because options are priced low relative to where they have been in the past, not relative to what the stock says theoretically they should be priced at. So I ignore historical volatility. I see it as a useless measurement, but I pay very close attention to implied volatility because that's what we're paying or receiving for option premiums.
Nice. Well answered, my friend. That was a good one. All right, so we've got you talked about delta, theta, vega, gamma, and rho. I mean, honestly, I don't really know anybody who uses rho, but that's just sensitivity interest rates, right? Sensitivity
interest rates, right? You know, a little grid that if your users want to take a picture of this, they're certainly welcome to. It's a little cheat sheet that I built to kind of help understand what happens or what can you expect to happen to your option premium, meaning is it a positive or a negative if this thing happens? And so if you read this up here, it says, depending upon your position, whether or not you're long a call or a put or short a call or a put, your option will either be positively or negatively impacted based upon rising underlying price, so stock price going up, rising implied volatility, rising interest rates, and time going forward. So if everything were to go up or forward, then this is how your position would be impacted. It would be impacted positively. You'd make money if the stock went up on a long call. Your delta would go up if on that long call, but you're losing money as time goes by, and you're positively sensitive to implied volatility rising. And if interest rates rise, your long call will benefit. That's what the plus and minus sign is. And this will help you kind of as a little cheat sheet that says, okay, if interest rates do change or if time goes by or volatility or stock goes up or down, how am I going to be impacted? This will help you build your positions out and really understand the impact.
But unless you're, if you're like myself and selling 30-day options, who cares? Interest rates aren't going to change that much. I mean, I guess this is probably going to be more impactful if I've got, some leaps or something, right?
Right. Yeah. Leaps are going to be more sensitive to interest rates, just like Vega is more sensitive long term. Interest rates sensitivity, rho, is larger on longer term options as well. So the longer you plan on staying in the position, you might be in the position to experience several rate changes. But for the most of us, we're not going to be even in these positions for several rate changes, which is why it matters the least out of all of them.
Right. All right. I think you pretty much wrapped up your Greeks, right? We got them all covered.
I mean, that's all the Greeks, unless you wanted me to go into like Voma and Lambda, and no, I'm not going to do all that.
Okay, can we let's talk about the Lambda, and the Omega moves. I think that would be
exactly. We could have fun with that.
There you go. Richard said, would implied be more of a discounting mechanism?
Would implied be more of a discounting mechanism?
I would say it's more of a smoothing mechanism. It's like taking a longer term moving average. You're using historical prices and kind of smoothing them out a little bit.
Well, implied volatility is real time. Historical volatility, yes, Merlin.
Oh, I'm sorry. I read it wrong. Yep.
Because that's actually smoothing out what has happened over the last 30 days.
Right, that's what I meant.
Implied volatility will change in an instant. Like you take somebody like Tesla, for instance, that had earnings come out, right? The last earnings report was July 22nd, and you can see that volatility shifted immediately. It dropped from 110% down to 85%. So it dropped 25% overnight. So essentially what ended up happening was anybody who owned an option on Tesla lost 25 vega points, 25, volatility points times whatever their vega was. So if they had a 20 vega times 25 volatility points, they just lost 20 times 25. What is that? 400 and something bucks?
Mm-hmm. Somewhere.
On overnight. And they could have been right on direction the whole time and still lost money. But implied volatility is real time. So if right now, Merlin, there was all of a sudden a big spike in demand for options, then you would see like a big spike. You would see an uptick immediately in implied volatility.
Right. Yeah, I got it backwards. I meant to say historical smoothing because obviously that's like a longer term moving average, but I read it wrong. So.
Yeah. You, I know that. I was just making sure that your peeps did.
Yep. Alpha says, does Corey hold overnight if he's trading a weekly option expiring this Friday? So you got a weekly options expiring Friday. You taking them home overnight?
I'll hold them overnight, but I'll usually try to get out. And when I say try, I mean I will find a way out before expiration on Friday. Okay. And oftentimes I'll close it out for, if we're all the way to Friday and it looks like it's about to expire worthless, I will close it out anyway. Which some people might say, well, why would you do that? Why would you close it out if it's going to expire worthless? Because most people think that options and options do stop trading technically at 4 p.m. Eastern, but the stock doesn't. The stock can still trade after hours. The owners of options can still exercise their rights up to roughly an hour and a half after the stock market closes. Mm-hmm. So if you get an after hours move that sends your out of the money option that you sold, for instance, into the money, and you're assigned on those after hours, you won't find out until Monday. And there has been some devastating events that have happened to people. I've seen people blow up their entire accounts overnight because what was supposed to expire worthless went in the money in the after hours. They were assigned, didn't know it, had no protection. On Monday, the stock was down enough to trigger a margin call and wipe out their account.
Yeah. Interesting you bring that up about trading times. I during the 2016 election, I had, 4 S&P contracts short. I had 80 put options on the S&P SPY, not the futures. And what was interesting is those futures contracts, I exited as we limited down on that election night. For those of you who might not remember, as it came clear and clear that Trump was going to win the election, the market just started falling apart in the after-hour session. I closed those out as we lock limited down, was actually playing a lock limit with the futures. With the options, I was looking at it going, oh my God, I'm going to have a massive profit tomorrow on this position. And what was interesting is you can't get out in that after-hour session. My options market was closed for that, so I couldn't do anything at that moment in time. And of course, you might remember by the time the markets opened up that next day, they were already higher and then just ripped and have not come down since. So one of the perks of trading futures versus options right there.
Or options on futures if you want that.
Yeah.
Which would allow you to trade those in the after hours.
Which we will be doing on this next election.
Yes, we will. Yes, we will.
All right.
Awesome.
So Corey, you got. I think we've done sharing your screen there. Let's get your beautiful mug back on the program here as we wrap up. You do all your stuff online right now. I know you've got Traders Army. You got a bunch of courses and programs coming up. Somebody asked earlier about education. What's your program look like, and how can they get in touch with you?
Yeah, so you can reach out to us. Actually, I'm still sharing, right?
Yep.
Unless you stop my sharing. So you can reach out to us here, right? Just tradersarmy.com. The phone number in the top left, 973-348-5022. Text us if you have questions, things like that, or you can just email us. You can contact us through here. But yeah, if you guys have any questions about anything that we do, we focus primarily on options and futures and stocks. We are building, and we just built and launched our Wealth Essentials program, which is focusing on longer term investing, 401k management, things like that.
Nice.
And then we're building some more material all around Forex as well over the coming months. So we got a lot of cool stuff coming. All the stuff that we're doing right now, teaching wise, is online. simply because of COVID restrictions. We're hoping to teach an on-site class in options in November out here in Southern California.
Oh, cool.
So if that, but they want to take, we keep our classroom sizes to around 15 to 20 people, and the local area that we want to actually rent the room from is making us rent an entire ballroom for 15 people, because everybody has to stay 6 feet apart.
Wow.
Plus, I don't know how comfortable people are flying and all that stuff. So we'll probably just do it online, but we do like to hold, on-site classes a few times a year. But most of our stuff's done online. It's just convenient for everybody.
Yeah, a sign of the times. It's definitely pushing that direction. Ariel says, Corey, mention the discount for the first month. I got to put you on the spot with that one.
Oh, yeah. So we always have little promotions running. So anybody who comes in, Chuck does his daily market commentary every morning on YouTube, and he offers the promo code Trader60, which gets you 60% off your first month. So there's that, and then every month after that, it just auto renews. So there's that, and then let us know if you're interested in any of our options intensive specifically, or one-on-one mentoring, or active trading, anything like that. That's an actual course. Let us know. If we've got promotions and stuff going on, say, hey, what are your promotions for this? And if we got any promotions going on, I love saving you guys money. So anything we can do to help you there is great.
Sounds good. All right, Corey. Well, thank you so much for coming on and helping me help everybody out with the Greeks. For those that ask the basic Greek questions, I'm hoping that you got your questions answered today.
Yes. And can I mention October 1st, Merlin, we're having another Trader Summit online all day. We haven't started promoting that yet, but October 1st, if anybody wants to put it on their calendar, if you've attended one of our online summits before, they can be a lot of fun. I tried to get you on that one, Merlin.
I know. I have some, let's just say, some constraints on what I can do. So
yeah, but one of these days we will have to get you in on something like that. But yeah, we got another one coming up October 1st. It's a Thursday. It'll be all day, so it's free. So you might as well come check it out.
Sounds good. All right, Corey. Well, thank you so much. Appreciate it. May all your trades be green. I hope your Dave and Buster's trade pans out for you.
Well, if we can just keep them from going bankrupt, then I think we'll be fine.
All right, we'll have to blame we'll blame COVID on whatever happens.
Actually, AMC did the same crap, and they're just fine.
Yeah.
So,
all right.
Awesome.
All right, buddy. Well, thank you so much. Talk to you soon, my friend.
Awesome. Talk to you soon, Merlin. Thank you so much, guys.
Guys, that was Corey Lane of Traders Army giving us some insights into the basics of the Greeks, because a lot of you have been asking about the Greeks. So, you know what, I figured let's just get Corey on, because he does a great job at explaining these things on a very simple level. Obviously, they go much more in depth. Tony out here, or Tom Lopez, says, do I need to know the Greeks to do options? I don't think that you don't have to, but boy, it certainly benefits you. I mean, I personally would feel a little bit naked if I was trading without understanding basics of delta, of vega, and of theta. I don't use rho or gamma at all, but just those little variables can kind of help you fine tune which strike price to be in, which one's going to work best for you, and knowing those risks. If you listen to Tim Blotzer, who was on the program the other day, trading without knowing delta would almost be impossible for his style, because he is using delta to assess the risk associated for that trade that he's taking. And if it's got a delta of 20, it's too high of a risk for him. He wants 18 or less. So he's not going to go with a 19 or a 20 or a 30 or a 40. He's making sure it's 18 or less because his strategy requires that. So immediately he's using that as a filter to stay out of trades that could potentially show some risk, too much risk for his account. All right, Tom says, I don't think I will ever follow you into a SPY put trade. That was a pretty bad one, wasn't it? Well, you had stop losses for a reason. So we got out, took a pretty bad loss on that one. I will make it up, certainly by the end of the year. That was a frustrating one. Sometimes you got to swing for the fences, and boy, man, that was one big swing and a miss. I felt like Jose Canseco in the World Series on that one. Corey is your only guest with a lot of hair. Joseph, come on, man. I actually cut my hair like this to make myself look older. That type of thing. All right, let me go through your economic calendar for tomorrow. Actually, I want to talk quickly about what happened today, and then I'm going to tell you guys about another presentation I got coming up here at 4 p.m. today, Pacific time, so about an hour and 15 minutes away from where we are right now. If you go to this screen here, you can see that today's news, there was some news that was not that great. The Philly Fed Manufacturing Index came right as expected. Unemployment claims surprisingly rose above expectations, right? They dropped by 33,000 previous week over week, but they were higher than expectations. So that is a little bit of a shock to the system. Nothing major, but just something to keep an eye on. What was noteworthy for me was these ones down below, building permits and housing starts. We talked about lumber's falling, and I think that's just a reversion to the mean with regards to lumber because it rose so quickly, but all of a sudden we're starting to see housing starts drop greater than expected and much bigger than expected. So maybe that lumber sell-off we saw in the futures market may actually be tying into a little bit of housing starts. So that's something I'll keep an eye on over the next few months as that number keeps getting reported. And also for the Canadians, my neighbors to the north, ADP non-farm employment change was negative 205, so not a good number there either. Now, let's look forward to tomorrow. For the U.S., we have current accounts, CB leading index, consumer sentiment, inflation expectations, nothing really that exciting. Canada has the good stuff, though. They've got retail sales and wholesale sales tomorrow, so that's good if you're trading the Canadian dollar, so keep an eye on that one. Yes, Joseph, I actually I'll talk about all my trades, winning or losing. It's okay for me to win. Yes, Big Up, I think I might actually, I'm kind of bummed because I wanted to, a couple weeks ago, be looking to open up some new put positions, but I just, not that I'm gun shy, I just had a lot on my plate right now, so I was distracted from that one. Now, I am going to tell you guys a little bit of I'm actually going to put this in the chat as well, because in about an hour and a half, I'm going to be joined by some very cool people. I am going to be, I'll bring this over here. I am going to be joined with Larry Jacobson, Bill Addis, and myself are going to be talking about what's happening in our economy, going a bit deeper into all the happenings going on, because it's a very strange, bizarre year right now, and you guys are all invited. This is open, so feel free to click that link. That's going to start in, 73 minutes according to YouTube right now. I think I'm going to actually do that one from here. We'll try with a bunch of different technology, and hopefully it all works out well. So, and that's, interactive. You guys can ask us questions, but it'd be nice to get Larry, Bill, and myself offering some insights and perspectives on a wide variety of topics pertaining to our economy. I know some of you are extremely bullish in the economy. Some of you are extremely bearish in the economy. This isn't anything to sway your opinion. I think it's just showing facts and figures out there that maybe will present some things to you that you may not have been aware of. So that will be happening here very, very shortly. Like I said, just under an hour and a half away, 72 minutes to be precise. You can join that one by clicking that link, or just go to Online Trading Academy's YouTube page. I'm just going on, and you can see it there. All right, guys, that's going to do it for me for today. Tomorrow will be Whiskey Friday. I am very happy to be cracking a nice glass of whiskey. I got a nice new bottle a friend of mine brought me, so we'll be enjoying that one on tomorrow's show. If you guys have questions, send them on in. You can go to TraderMerlin.com and send them in that way. You can also post any questions down below the video on this YouTube page. I'll get to all those with priority. Also, click that thumbs up button. Share it if you like. If you enjoyed Corey Lane today, that also helps us out. Click that thumbs up button. I will see you all tomorrow. Take care, everybody.